Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So I think when you put it in that perspective, it does make sense because instead of you've lowered your break-even point. So even if we go up and retest where we got in, if you had your straight call option, you'd still be at a loss here. Whereas rolling down over time, as you move forward towards expiration and you come in to retest where you got in, you have the potential to get all of your money back plus a possible 25%. Now, it's not a great risk-reward scenario, but recognize you're on the losing side of the trade to begin with. So you're losing right away, and this just gives you, buys you a little bit more time to essentially repair and possibly break even, if not get back your original position. So. Good point on that side, and that's going to be based on just analyzing the specific trade and whether or not, like if you can recreate the position without any additional cost and still stay with the trade, then that is the ideal position.
So this approach sort of works well in a moderate. If you believe that it's going to be moderately bullish, it makes sense. If you think it's going to have a big move up or a big move down, it probably doesn't.
No, I mean, at the end of the day, if this thing is going to continue aggressively to the downside, then it's not something that is your best just to cut your losses. But if you anticipate that in this case, this 72.5 is a very is a support level that's going to be respected, rather than making it a 50% loss on the premium, which is essentially what we've suggested that option contract would be. We reposition ourselves recognizing that any bounce off of this is going to allow us to get back some of our profit or some of our premium, and if not conceivably profit, as we trade back up into this resistance level. But as we said earlier, every trade opportunity, every position is going to be different, and you need to run through the scenario. That's why these trade simulators are fantastic and these position calculators, because you can go in and say, okay, you know what, this is not worth my while. I'm going to talk about some of the things, again, some of the considerations that you want to go through before you actually look to initiate this trade. But just recognize that there are ways that you can, again, reposition. In this case, we've repositioned at a lower strike. We've lowered our break-even point on the trade from 78.5 down to roughly 74.5.
Right.
So, any other comments, Steve?
No, I mean I think that makes a lot of sense. It's the repair strategy, and I teach this also in the equity options world, where you had, maybe you had a covered call or something like that, and now, what are you going to do when it turns against you? You can actually do that. We call it the 1x2, which basically creates long an underlier and long an in-money option, and now you're short two other options. I mean, it's very similar. It's a repair, and like you said, if you got into a trade and it didn't work initially, your risk-reward is probably not going to look that good because you didn't get in at the right time. Yeah,
I mean, don't look to make money on this particular repair strategy. Look to at the most break even, but at the very least recoup some of your losses on a bounce as it trades towards that lower strike. Because remember, what you've done, you've lowered all the way from 75.5 down to 70.5. This option contract here is going to hold its premium value a lot longer. It's not going to be subjected to time depreciation. It's going to move a lot more closely to the underlying pair value than the ones that you've sold up in here. So the idea is that you lower your break-even point, you look for a bounce, you maybe get your losses from 47% up to even a 20% loss, which is a lot more attractive, and you move on and you say, hey, that was a loss. Again, remember, the reason why you're doing this is because you're losing. And this is a way that you can get in and conceivably lose less. I've had this work for me in the past. Taser, for example, several years ago, I just didn't want to let it go, and I rolled down actually 3 times and then got a nice little big rally in the stock based on, and this is way back when that stock had some value, and managed to get out with my capital. But at some point, or with the initial cost of my trade, at some point you have to say, look, I'm wrong. This is crazy. Let's move on and look for another opportunity. It's as simple as that.
Reasonable expectations, yeah. Okay, that makes.
You got it. So just again, I think we've significantly covered that break-even point on this trade. Now, instead of 78, is your 70.5 strike plus the $4 total cost of your trade. So you're looking at essentially 74.5 as your break-even point. You can make anything above below 75.5, which means all you can make is an additional $1 if the pair value is trading, as I mentioned over here, above 75.5 on expiration. So I'm actually almost through most of these slides, Steve, so we can take some questions at the end, and maybe that might be a little better than just kind of stopping, if that makes sense to you.
Yeah, perfect.
Yeah, this is a little bit of a shorter presentation. You guys are used to my long-winded ones. So,
Good, Dave.
All right, so good stuff. So again, to review this strategy, we were long the 75.5 call option at $3, anticipating a move. Remember, I apologize, the pair value was at 75.20. We went long the 75.5 call at $3, but we were wrong. Okay, we see the EUI drop, and the call is now worth about 45% less than what it was. So we're going to sell the original plus an extra one, and we're going to collect $3.30. We're then going to simultaneously buy that 70.5 call option, repositioning our long position down at that 70.5 strike, and that's going to cost us $4.30. So the $3.30 credit is applied to the $4.30 for that lower strike price. Remember, we're actually buying at this point $2 and basically $2 of intrinsic value as well. So keep that in mind when you reposition at this level. So the result is a 70.5 by 75.5 spread at an additional cost of $1. So you turn the possibility of a 45% loss into the potential profit of 25% by repositioning. Now again, this is all based on probabilities and possibilities. There is a possibility that we break below that 72.5 line, and it continues down towards your now new long position of 70.5. And recognize if it breaks below that, of course, all your intrinsic value on that position will be gone, and all options will expire worthless. So some important considerations. First of all, again, at some point you're going to have to admit that you're wrong. This is just an initial sort of strategy that you can use if, again, you're trading close to a support, it's taking you on a little roller coaster ride, but you think that you're going to get a bounce. At the very least, you reposition at a lower strike, and you're not going to make as much percentage-wise, but at least get your capital back, possibly a little additional. I mean, a 25% profit on that position is not something to scoff at if you're originally down, significantly on that. Again, this gives you a chance to lower your break-even point, which means that the EUI in this case does not have to rally as much for you to begin to recognize an increase in your position and possibly profit. Now, the other thing is that you can close that spread out at any time if it's profitable, or if you're sufficiently comfortable with what you've been able to recoup on the position. You can close it out at any time, or if it starts to break below that support level, you can close it out, sell that 70.5 call, and buy back that 75.5, and collect as much of the of your original cost as possible.
Thank you for listening to our podcast.